In this video, we discuss the basics you must know prior to trading Forex or foreign exchange. The $7.5 trillion daily Forex market is the largest financial market on Earth, bigger than all stock exchanges combined. While 98% of the trading volume in Forex markets is done by institutions, many retail traders and ordinary individuals trade Forex, some as a full-time career, and others more casually in a quest to build capital. Let's be clear. Forex trading is not a get-rich-quick scheme. Though it is quite accessible, you can start with as little as $50 and scale systematically as your skills develop, it's still a sophisticated skill that requires proper education, disciplined execution, and unwavering risk management. These statistics are sobering. 80 to 90% of retail traders lose money, not because the market is rigged, but because they lack the fundamental knowledge and necessary experience. Therefore, in today's comprehensive video, we will cover critical components: market mechanics and currency pair dynamics, proven technical analysis methodologies, Forex trading strategies, and the risk management frameworks that separate profitable traders from the statistics. By the end of this session, you'll understand exactly how professional traders approach this market. Before we begin, I'd like to point out that although in my early years I did trade Forex with some success, I later moved to trading stocks and remained there for over 30 years. Much of the technical skill is similar for both Forex and stocks, but I found my edge improved when I focused on stocks in combination with the fundamentals. Anyone interested in my approach can get my free ebook using the links below. Down there you'll also see links to our group and my bespoke breakout scanner, saving hours of searching for the right stocks to trade. With that said, let's dive in. Let's start with understanding currency pairs and market mechanics. Forex trading is fundamentally the simultaneous buying and selling of currencies. When you exchange your local currency for US dollars before traveling abroad, you're participating in the Forex market. The difference in online trading is speed, leverage, and the ability to profit from both rising and falling currency values. Every Forex transaction involves a currency pair. For example, EUR/USD represents the euro against the US dollar. The first currency is the base currency, and the second is the quote currency. When you buy EUR/USD, you're purchasing or going long in euros while simultaneously selling or shorting US dollars, anticipating that the euro will strengthen relative to the dollar. Currency pairs are categorized into three groups. Major pairs include the 7 most traded combinations, all involving the US dollar. These pairs offer the tightest spreads and highest liquidity, making them ideal for beginners. Minor pairs, or cross-currency pairs, do not include the US dollar. Examples include the pound and yen, euros and pounds, and Australian dollars and Canadian dollars. These pairs typically have wider spreads but can offer excellent trading opportunities for experienced traders who understand their unique characteristics. Exotic pairs involve currencies from emerging economies paired with major currencies, such as US dollars to South African rand or euros to Turkish lira. While potentially profitable, these pairs carry higher volatility and wider spreads, making them unsuitable for novice traders. The foreign exchange market operates 24 hours a day, 5 days a week, connecting banks, institutions, and individual traders. Trades happen across 4 primary sessions, each with distinct characteristics. The Sydney session opens the trading week, followed by Tokyo, London, and New York. Understanding session overlaps is crucial. The London-New York overlap from 8 a.m. to 12 p.m. Eastern Time typically provides the highest volatility and trading volume. London controls over 35% of global Forex volume, making it the undisputed center of currency trading. During London hours, you'll observe the most significant price movements, particularly in euros, pounds, and Swiss franc pairs. The New York session, controlling about 17% of volume, often sees strong movements in US dollar pairs, especially during economic announcements. Before executing your first trade, you must understand the core mechanics that determine your costs and potential profits. The first is bid-ask spread, your trading cost. Every currency pair displays two prices, the bid and the ask. The bid represents the price at which you can sell a currency pair, while the ask is the price at which you can buy. The difference between these prices is the spread, your immediate cost of entering any trade. For euros, US dollars, you might see a bid of 1.1050 and an ask of 1.1052. The small price differential means you're paying 0.0002 in transaction costs. Therefore, a $1,000 position would cost you 20 cents, a relatively small expense. Major pairs like Euro-USD typically have smaller spreads of 1 to 3 pips, while exotic pairs can have spreads of 10 to 50 pips or more. Tighter spreads reduce your trading costs and improve profitability. The second is understanding pips, measuring market movement. A pip represents the smallest price movement in a currency pair, typically the fourth decimal place. When the Euro-USD moves from 1.1050 to 1.1051, that's a 1 pip movement. For Japanese yen pairs, which quote to 2 decimal places, a pip is the second decimal place. Dollars yen moving from 155.20 to 155.21 equals 1 pip. Understanding pip values is crucial for calculating profits and losses. The third is lot sizes, position volume. Forex trades are measured in standardized units called lots. A standard lot equals 100,000 units of the base currency. Mini lots represent 10,000 units, micro lots are 1,000 units, and nano lots are 100 units. Let's use Euro-US dollars at 1.1050 as an example. One standard lot is equal to 100,000 euros and is worth about $10 per pip. One mini lot, 0.1, is about $1 per pip. One micro lot, 0.01, is about 10 cents per pip. And one nano lot, 0.001, is about 1 cent per pip. These days, most brokers don't lock you into fixed sizes like 0.1 or 0.2 lots. You can type in almost any size you want, such as 0.13, 0.27, or 0.005, so you can match your risk exactly. For example, say you have a $5,000 account and you want to risk 1% or $50 of that on a trade with a 40 pip stop. You choose a lot size of 0.125. That means each pip is worth $1.25, so 40 pips times by 1.25 is equal to your $50 risk. The fourth is leverage and margin, amplifying your capital. Leverage is a crucial element in Forex trading as most traders use it to amplify their trading returns. Unlike stocks, there are limited trading options in Forex, and most Forex pairs, especially the most liquid ones, don't see wild moves as some stocks do. Therefore, traders readily use leverage to profit from the small moves. Leverage allows you to control larger positions with smaller capital deposits. With 1 to 100 leverage, you can control a $100,000 position with just $1,000 margin, which is the required deposit held as collateral. Your margin requirement equals your position size divided by leverage. Remember, leverage amplifies both profits and losses equally. A 1% adverse movement on a 100 to 1 leverage position results in a 100% loss of your margin. Use leverage conservatively. It's a tool for opportunistic profiteering, not speculation. Let's now understand the fundamental factors that move the Forex markets. Currency movements are driven by macroeconomic fundamentals that reflect a country's economic health, monetary policy direction, and global risk sentiment. Understanding these factors provides the essential context for why currencies strengthen or weaken, often overriding technical analysis during major economic events. Interest rates, the primary driver. Interest rate differentials represent the most powerful force in Forex markets. When a central bank raises rates, its currency typically strengthens as investors chase higher yields. The Federal Reserve hiking rates while the European Central Bank maintains an accommodative policy creates a bullish environment for the US dollar against the euro. Central bank communications often matter more than actual rate changes. Hawkish language suggesting future tightening or rate increases strengthens currencies, while dovish tones indicating continued accommodation weaken them. Markets frequently move on forward guidance rather than current policy decisions, making central bank speeches and meeting minutes crucial for traders. Economic growth and employment. GDP growth rates indicate economic vitality, attracting foreign investment and strengthening currencies. Strong growth suggests productive capacity expansion and future rate hike potential. Conversely, contracting economies typically see currency weakness as capital seeks better opportunities elsewhere. Employment data also creates significant volatility. Strong job creation indicates economic health and potential inflationary pressure, often leading to currency appreciation. Unemployment rates and wage growth provide additional context for central bank policy expectations. Inflation dynamics. Inflation creates complex currency effects. Moderate inflation suggests healthy economic growth, potentially strengthening currencies through rate hike expectations. However, excessive inflation can weaken currencies by eroding purchasing power unless central banks respond aggressively. Key inflation indicators include the Consumer Price Index, CPI, and Producer Price Index, PPI, which each currency trader must watch out for. Trade balance and capital flows. Countries with trade surpluses typically experience currency strength as export demand creates natural buying pressure. Japan's consistent trade surpluses historically supported yen strength despite low interest rates. Trade deficits can weaken currencies, particularly when financed through foreign borrowing. Foreign direct investment, or FDI, and portfolio flows significantly impact currency values. Capital inflows strengthen currencies as foreign investors must purchase local currency to invest. Political stability and the regulatory environment influence these flows substantially. Geopolitical risk and market sentiment. Risk-on sentiment benefits high-yielding currencies like the Australian or New Zealand dollars and emerging market currencies as investors seek returns. Risk-off periods strengthen safe haven currencies, the US dollar, Japanese yen, and Swiss franc, as capital flees to perceived safety. Political uncertainty, elections and geopolitical tensions create volatility. Brexit uncertainty weakened the pound for years, while trade war concerns impacted multiple currency pairs. Central bank independence and government fiscal responsibility also affect long-term currency credibility. The fundamental factors can be useful in determining the directional trend in the market. For example, if the US is seeing increasing interest rates and higher economic growth with no geopolitical risk, its currency will be in an appreciating trend. So the euro-US dollar pair will have a declining chart, indicating the euro losing value versus the US dollar, or the USD gaining value versus the euro. After all the fundamental analysis comes the core part: trade planning and execution. The first step in taking trades is learning to read charts or basic technical analysis, which forms the foundation of most successful trading strategies. Price movements reflect the collective psychology of market participants, creating recognizable patterns that repeat over time. One such pattern is price reaction at support and resistance levels. Support and resistance levels are core concepts in technical analysis that can be extremely helpful while trading Forex. Support represents price levels where buying interest historically emerges, preventing further declines. Resistance indicates levels where selling pressure typically appears, capping upward movements. These levels often coincide with psychological round numbers, for example 1.2000 for Euro USD or 110.00 for US dollar and yen. When support or resistance levels are broken, they often reverse roles. Former support becomes resistance, and vice versa. Let's dig a little deeper into trend analysis and market structure. Markets move in three directions: upward trends, downward trends, and sideways consolidation. Uptrends are characterized by higher highs and higher lows, indicating sustained buying pressure. Downtrends show lower highs and lower lows, reflecting persistent selling pressure. The concept of multiple timeframe analysis is crucial. Professional traders analyze longer timeframes to identify the primary trend, and then use shorter timeframes for precise entry and exit points. For instance, as a Forex day trader, you might identify an uptrend on the 4-hour chart and then use the 15-minute chart to time your entry during a temporary pullback. Trend lines connect significant highs or lows, providing dynamic support and resistance levels. A properly drawn trend line should connect at least 2 points and ideally be tested multiple times. The more times a trend line is tested without being broken, the more significant it becomes. Let's discuss risk management, the foundation of profitable trading. Risk management isn't just important, it's everything. Without proper risk management, even the most accurate analysis becomes meaningless. Professional traders focus more on managing risk than on being right about market direction. The 1% rule states that you should never risk more than 1% of your account balance on any single trade. With a $10,000 account, your maximum risk per trade should be $100. This conservative approach ensures that even a series of losing trades won't devastate your account. Position sizing calculations determine your lot size based on your risk tolerance and stop-loss distance. If you're risking 1% of a $10,000 account, $100, with a 50 pip stop loss on Euro USD, your position size should be 0.2 lots, where each pip equals $2. Stop losses are non-negotiable. Every trade must have a predetermined exit point that limits your loss. Place stop losses based on technical levels and not arbitrary percentages. If your analysis suggests support at 1.1950 for Euro USD, place your stop loss slightly below at 1.1940. Some choose take profit levels, and these should generally offer at least a 1 to 2 risk-reward ratio. If you're risking 50 pips, target at least 100 pips profit. Many successful traders use 1 to 3 or even 1 to 4 ratios, understanding that they can be wrong more often than right and still remain profitable. My own trading is somewhere between 1 to 3 and 1 to 4, although I tend not to aim for a target. I prefer to ride the trend and look for exits. Each have their own merits. Let's move to perhaps the most important topic in Forex or any other form of trading: trading psychology and emotional control. Trading psychology often determines success more than technical knowledge. Fear and greed are the primary emotions that destroy trading accounts. Fear prevents traders from taking valid setups, while greed encourages overleveraging and revenge trading. Develop a comprehensive trading plan that includes your strategy, risk parameters, and trading schedule. When emotions run high, refer to your plan rather than making impulsive decisions. Document every trade with entry reasons, exit strategy, and post-trade analysis. Revenge trading, which is attempting to quickly recover losses through larger positions, is perhaps the fastest way to destroy an account. Accept that losses are part of trading. Focus on executing your strategy consistently rather than trying to be right on every trade. Let's move to a practical trading framework. Here's a simple yet effective strategy framework that's perfect for beginners. Firstly, begin by identifying the overall market trend using the 4-hour chart. Look for a series of higher highs and higher lows to confirm an uptrend, or lower highs and lower lows to identify a downtrend. Next, draw a trend line to validate the trend and establish a dynamic support or resistance level. To form a reliable trend line, you'll need at least 2 bounces or rejections. A third touch strengthens its validity, acting as firm support in an uptrend or strong resistance in a downtrend. To better understand how trends behave, let's briefly revisit Dow theory. If you're new to this concept, you can check out our detailed video on the channel for a deeper explanation. According to Dow theory, there are 3 types of trends. First, primary trends represent the main long-term direction of the market. Second, secondary trends are intermediate movements or corrections that run counter to the primary trend. Finally, minor trends are the short-term, day-to-day price fluctuations within the secondary trend, often considered simple market noise. Coming back to our Forex trading strategy, once you've identified a clear uptrend on a higher time frame, say the 4-hour chart, your goal should be to enter the trade on the next pullback to the trend line. This pullback represents the secondary trend in Dow theory. Now, after identifying the primary trend, one of three things can happen. The price may not retrace to the trend line and continue making higher highs and higher lows. The price may pull back to the trend line, take support and bounce higher, or the price may break below the trend line, marking the end of the trend. You must prepare for all three scenarios. The easiest and most common is the second one. So let's start with that. Here's a dollar-yen chart on the 4-hour time frame. The pair has been in an uptrend ever since it started forming higher highs and higher lows. If we draw a trend line connecting these two major lows, you'll notice that the price stayed above this line and tested it twice more before eventually dipping below it. Now let's see how to trade these bounces from the trend line. First, move to a shorter time frame, such as the hourly chart, to observe the secondary trend. In this shorter time frame, you'll typically notice a sequence of lower highs and lower lows. That's your secondary trend. To enter in the direction of the primary uptrend, we wait for the secondary trend to break. That break happens when the price forms a higher low followed by a higher high. In this case, the higher low appeared near 153. As the price rebounded from that point and broke above the recent high of 153.54, it confirmed the end of the secondary trend. That breakout at 153.55 becomes your entry point for a long trade, with a stop loss here at 153. The trades delivered 3 times the risk within 5 days, and 6R in just 10 days. A similar setup appeared again, with an even tighter stop loss offering a 10R reward or 10 times the risk. Now let's consider the first scenario, where the price does not pull back to the trend line. In this same dollar-yen chart, the uptrend began here and can be confirmed by this trend line, but after that the price never revisited the support. Suppose you are waiting for a pullback. Its absence may have kept you on the sidelines. Here's how you could still trade this move. Once again, on the lower time frame, the secondary trend shows lower highs and lower lows. To catch the next move up, wait for a reversal pattern, a higher low followed by a higher high. In this example, the higher low formed at 150.27 and the breakout occurred when the price moved above 151.2. That breakout would serve as a valid entry point for a swing trade, with a stop loss at the recent low. If your stop loss is that wide, adjust your position size to ensure your total risk remains under 1% of your capital. This trade yielded 2R in 7 days and 3R in 9 days, a solid positional setup that could also be trailed using a trailing stop loss. However, keep in mind, it's much easier to identify and trade when the price clearly takes support from a trend line. When it doesn't, these setups become trickier. You might easily mistake a short-term bounce for a genuine reversal, leading to a premature entry and a stop out. To avoid such low probability trades, use trend lines on the secondary trend as confirmation. Draw a trend line connecting the lower highs of the secondary move. You'll need at least 2 clear highs to do this. If you don't have them yet, don't rush the trade. In this case, the second high appeared here, and connecting them created a descending resistance line. Now you wait for the price to confirm the reversal, not just with a higher low and higher high, but also by breaking above this trend line. When that happened, it validated the entry. The key idea is this: don't rely on a single signal. Wait for a confluence of factors, trendline break, higher low, higher high, to filter out low-quality setups and improve your win rate. Finally, let's discuss the third scenario, when the price breaks below the trend line, signaling a trend reversal. Once the price starts trading decisively under the trend line, treat the previous uptrend as over. You can then look for new opportunities in the opposite direction, but only after confirming the new trend with lower highs, lower lows, and supporting trend lines on higher timeframes. For exits, stay flexible. You can choose to exit the full position at 3x your risk, exit half at 2x and the rest at 3x, or trail your remaining position with a moving stop loss near recent swing lows. Alternatively, you can use indicators like the MACD or moving averages to capture bigger trending moves. As part of a robust risk management framework, you could consider moving your stop loss to break even once your trade reaches 1R profit. That way, you protect your capital and let the market reward your patience when it moves in your favor. Let's now discuss the final piece of the puzzle: platform setup and execution. MetaTrader 5 remains the industry standard for retail Forex trading. Familiarize yourself with order types: market orders for immediate execution, pending orders for future execution at specific prices, and stop and limit orders for risk management. Practice on a demo account until you can execute trades flawlessly without emotional interference. Demo trading allows you to test strategies and familiarize yourself with platform functionality using virtual money that mimics real market conditions. When transitioning to live trading, start with the minimum position size your broker allows. Focus on execution quality and emotional control rather than profit maximization. Gradually increase position sizes as your confidence and account balance grow. Most importantly, risk management determines long-term success. The 1% rule, proper position sizing, and disciplined stop-loss placement protect your capital during the inevitable losing streaks. Trading psychology and emotional control often matter more than technical expertise. Your next steps are clear. Open a demo account with a reputable broker, practice the concepts discussed today, and develop your trading plan. Focus initially on consistency rather than profitability. Master the mechanics, refine your strategy, and gradually transition to live trading with appropriate position sizes and risk management. Remember, Forex trading, like any strategy, is a marathon and not a sprint. The traders who succeed long-term are those who approach this market with respect, discipline, and continuous learning. The $7.5 trillion daily volume ensures ample opportunities for those who prepare properly. As always, thanks for watching, consider subscribing, and use the links below to get my free ebook and join our group.